Welcome, everyone. We are back for another installment of Old Guys in T-Shirts. I'm Brett Danko.
I'm Rob Kron.
And as always, we're excited to be here. Now, Rob is wearing his vintage Atari shirt, which I love, and I am wearing my college shirt from Animal House, to which my daughter came out after I bought this a number of years ago, and she said, she was 14 at the time, and she said, "Dad, I don't get it. What college?" It was great. Like, she had never seen the movie. So I said, okay, someday you'll see the movie and you'll laugh. And if you never see the movie, it just means that we're old. So anyway.
And we're in T-shirts.
And we're in T-shirts. So we're going to talk about credit today. Everything credit. So we're going to talk about how to get credit, why it's important, credit reports, how to deal with terms of bankruptcy and things like that. We're going to be talking about all those aspects. So buckle up. It's going to be unbelievably exciting and awesome.
And but Brett, before we get started,
no, I don't even think you realize how awesome it's going to be. No,
I do, but
I'm awesome.
Before we get started,
yeah,
I have to ask you a personal question.
Oh well, Rob, we don't know each other that well, but go ahead.
What is credit, and why is it important?
Oh, you wicked monkey, you.
Somebody had to ask, Brett.
Somebody did have to ask. Okay, actually, he's asking. We actually have fun while we're doing these, by the way. So what is credit? Because people are like, oh, this is boring, and you're talking about credit. No, credit's unbelievably important. If you want to rent an apartment, you want to buy a car, you want to go ahead and get credit cards, you want to get a mortgage at some point in your life. All these things, people are going to be looking at your credit report. People are going to be wondering, should they lend you money? That's really going to be the big thing here. So what we're doing here is we're asking other people to be willing to lend us money. So we need this in life. We need it, and we need to start once we, are 18 to 21 years of age. But then it's, how do we do that? Right. And I think that's one of the things. So how I did it, and I think how you did it, was when we were 18 years old, and I remember I was the first day at University of Pennsylvania, they had a big thing for, I think it was Bank of America. I'm pretty sure it was Bank of America. But I just remember I was all excited because they had these really cool people there, and they were giving out T-shirts if you just filled out an application. And I got $500 of credit. And I thought it was the coolest thing ever. I mean, this was free money. Yeah. We never talked about this stuff. I was like, I'm going to run this thing up in a day. And it took me about a week, but boom, did I run it up.
Not anymore. You can't do that anymore. And
why not?
I know. I regret. I had the same tent.
I mean, I loved paying 22% interest. I mean, I thought it was
great. Love my free T-shirt. I too, right? Freshman year, you get that credit card. You go buy stuff. And that's how we established credit, right? But in 2009, they changed the rules. So credit card companies aren't allowed to set up shop on college campuses anymore, handing out free T-shirts to anyone who signs up. They can set up on campus and just hand out free T-shirts to everybody.
Got it.
Just to hand them out. But you can't hand out stuff in exchange for filling out a credit application. And they also can't issue a credit card to someone under the age of 21 who can't demonstrate an independent ability to qualify for that level of credit. So, again, just being a freshman in college doesn't count anymore.
Well, wait, but can I co-sign as a parent?
So, yes, ways you now can get credit. So you can't just show up at the tent, get the free T-shirt, and now suddenly start building your credit report.
They've ruined everything.
They really have. Now, you need to have a parent co-sign with you prior to the age of 21 if, again, you want to start building credit that early. And the other interesting option, though, is if you take out the guaranteed federal loan, the $5,500, at least this year that they're allowing you to take out, by taking that out, 6 months after you've taken out that loan, it'll actually start counting towards your credit score.
Oh, wow.
Yeah.
Okay. All right, so we've been talking about establishing some credit, things like that, but then it actually goes on a credit report, and then we can get a credit score. So, come on, that's fancy.
That is.
Fancy. Come on, so what are some things we should be knowing about that?
Right, well, so that credit report. I think that we should start there because that's kind of where this all starts. You need a credit report in order to get a credit score. And your credit report is a history of your use of credit. And so if you haven't used any credit, you clearly don't have any history. I think the latest stat I saw was there are about 53 million people in the U.S. who don't have a credit score. They don't have enough history of credit in order to have a credit report that would generate a score. So this credit report's really important. It's then what's going to be used to calculate a score. And this score is essentially a way that lenders judge how likely it is that if they loan you money, you're going to pay them back. That's essentially what the score is. And scores usually range from 300 to 850. So if you have a 300, means you are highly unlikely. I actually don't know that anyone has ever scored 300, but if you did, it's like that is the worst possible score. And chances of you paying back are slim to none. It's actually the chances of the Pittsburgh Steelers actually winning a game this year.
Ouch!
Yeah, sorry, couldn't help it.
Come on, man. Dude, that hurts.
I know it does. It's the same as the Broncos actually winning a game this year.
They're going to win.
My team.
They're going to win at least one. I know they are. It might even be this weekend.
Okay,
so,
right. We can all dream. We can all dream.
So, dude, you got personal.
I did. I couldn't help it. All right. So, credit report is again really important. It's the history of all the credit you've used, and it drives then your credit score, which lenders are using to determine how good a risk are you.
But wait, but there's, when we do the credit score, 5 things that are important for most credit scores.
Mm-hmm.
So my age, right? Or how much money I make, right?
No, Brett. No, age not important.
How much money
you make, where you're employed, none
of
that. What
about if I put product in my hair?
If you
does
put
that
product
count?
in, it does with me. It does with me. It counts with me.
I got a little product, and I think he does too. I think there's a little product in there, but it's all good. But you're telling me product doesn't count.
What little hair I do have, yes.
All right.
But I'm telling you, none of that actually counts.
So what does count?
So on your credit report is essentially just your use of credit. It's not how much money you make or how much money you have or where you work. None of that stuff shows up on that credit report. Even hair product and types of hair, that doesn't show up. It should, but it doesn't.
It should.
So it's really just your use of credit and the accounts that you've had and how long you've had them and how you've managed them. And so the credit companies then take all that information and create a score for you, which we mentioned before. And as Brett mentioned, there are 5 basic categories that they're looking at in all that data on your credit report to calculate that score. The most important thing they're looking at is your account history and your payment history. So have you made your payments on time?
That was one.
That's the most important.
35%
of your credit score is driven by that history.
That
all right, number two is level of debt, or what we'll call credit utilization.
It's a big word.
That is a big word. It's 2 big words. This is essentially how much credit do you have, so your credit limit, as a ratio to how much of it you're actually using. And they look at it in 2 different ways. They look at it by individual account. So for every card you have or every loan you've taken out, what's your credit limit and how much of that limit are you currently consuming? And they'll do that account by account. And then they'll do it in aggregate. So they'll look across all the accounts that you have. And obviously if you have a high utilization, that's not good. And if you have a lower utilization, that is good.
All right, stop. Because I'm going to talk about me. This is all about
it's about
me.
time.
Okay, so it's all about me. No, I'm being serious, because this is one of the things Rob and I were talking about before recording this. You know, my credit history is very solid. However, my debt utilization messes up my credit score. And the reason why is I have my own businesses. So for Brett Danko LLC, Main Street Financial Solutions, we charge a lot of things. So
is this a commercial, by the way?
No, stop it.
Should we put a big
No. My point is, no, it really hurts my credit. It really hurts it. Seriously. It's and it's because I go ahead and I pay it off every month, but they look at my balance in full every month. So I'm paying it off. However, there's a very high amount of money that I'm paying off every month. So therefore, they look at it and they say, oh, well, you're going ahead and you're using on this, or using a big chunk of it. Also, I tend not to increase my amount of credit that I have. They'll send me things. Do you want to increase your credit? I'm like, no, I'm at 30 grand. I'm good for this card. And they'll say, hey, do you want to take out more credit cards? And I use 3 cards essentially, and that's it. So I don't even take out other credit cards because I'm like, no, I don't want to take those out, etc., etc.
That's hurting you.
But that's hurting me. So what are some ways that I can get around that?
So
not get around it, but
help out your situation, right? So again, what they're looking at is they're looking at how much of your available credit are you using, because as you get closer and closer to that limit, their assumption is that now you're making it more and more difficult for you to make all of your payments. So one of the easy ways is when they ask you, do you want to increase your limit? You actually should say yes.
Sure,
right?
Yeah.
It doesn't mean you have to use it, but now what you've done is you've changed the math on that ratio. The other thing that I've read that people have done to help with this particular element is related to just making their payments. So the simplest way is just like you might on a mortgage make an extra payment, so you're paying twice a month instead of once a month. You can do that with your credit card too. If you make a credit card payment halfway through the month and then one at your due date, what that'll do is it'll decrease the outstanding balance you have and help with, again, that credit utilization score. Now, the more scientific way to do this is find out when does your credit card report your balance to the credit agencies, and then just make sure you time your payment to be a couple of days before that. And so most people are timing their payment to the due date on the credit card statement.
Which is what I do. It's an auto pay and it goes on the due date.
Right, because again, what you're trying to take advantage of that full grace period, right? Yep. But with rates so low, it's not like you're making a ton of money by holding back that payment an extra week, right?
Yep.
So if it's going to help with your credit score by sending that payment an extra week early, then you might want to do that. So those are the 2 things I suggest, is you just pay more than once a month, or you find out the timing of when that gets reported and make sure your payment's a couple of days ahead of that.
And this affects a lot of folks who own their own businesses, because it's actually your Social Security number that's guaranteeing that debt. They're not saying the entity is borrowing the debt, it's the individual. So if we have payments and debt utilization, which are around 2/3, about 65%, what are the other 3? So we're on number 3.
Yeah, we're on number 3. But I want to add one point though.
No, but we're on number.
Yeah, well, because you were talking about for people who own their own business, how important credit utilization is. Yeah. I think for people just starting out, so a recent college graduate, right, who's got just the one credit card and your student loan, and that's what's driving your credit score, you need to be really careful that if you are using that as your cash flow device, that you understand that if your spending is taking you up to that limit, and that's what's getting reported to the credit card companies, that's going to hurt your score. So you own your own business, it's really important to pay attention and maybe think about those techniques. But also, if you're a new consumer to credit and you're really trying to build that score.
So should you take out another credit card or take it out with your parents where they're co-signing on it?
Well, you can. Again, once you've qualified for that first one and you've now built sufficient credit that someone else will issue you a new card, you probably should do that. However, now you've mentioned what are those other elements. So there are 3 other elements, and one of them is how many times have you made what's called a hard credit inquiry? So you requested a new credit card, or shopped for a mortgage or a car loan, or again, any type of request of, hey, I'd like to borrow money. That's going to show up as an inquiry. And if you have too many of those in a short period of time, that will hurt your credit. And so then that's why you need to be careful that, well, yes, it's good to maybe go get another credit card so you have more of a credit limit. If you're just starting out, it may make more sense to call up that credit card company and just request a credit increase, which will also affect your, that's an inquiry, that'll hit your score. And then also look at timing your payments so that, again, you're not reporting a high balance.
What about all those folks that get in the mail every single day Get our card and you can be a rock star. Get our card and you'll be beautiful. Get our card and you won't need product in your hair.
We had to buy a separate wheelbarrow in order to transport all of the offers we would get for all of these. It's not just credit cards. It's, personal loans. And it's amazing the number of people who want you to borrow money from them once you have a decent credit score. And all of those are not, in fact, impacting your credit report or your credit score. Those are what are known as soft win inquiries. And so you don't have to worry about those hurting your credit report.
Okay, so the fourth one then is...
So I jumped down to the very last one, which is the number of inquiries. That's 10%.
Okay.
Also at 10% are the types of credit you're consuming. Yeah. So there's fundamentally two buckets. There's revolving debt, which are credit cards and other kinds of lines of credit. So it's not a fixed amount that you borrowed with a scheduled payment plan, but it's just kind of like, okay, you have a credit limit of $30,000 and you can spend anywhere in there or borrow in there whatever you need. So that's a revolving account. And then they have installment or non-revolving, which are mortgages and car loans and those types of things. So having both helps your credit score. And also in the installment category, having a variety of different installment loans will help your score. So having the car loan and the mortgage and the boat, which everybody aspires to. I'm glad you brought that up earlier.
The boat.
So
you know what BOAT stands for? Break out another 1,000. That's what it stands for.
I'd heard, yes, the best days in a boat owner's life, there are two of them. The day you buy it and the day you sell it.
And now that we're insulting boat owners, because it's awesome having a boat, but a buddy of mine, we were out on his boat, and I said, this is awesome, maybe I should get one, whatever, and he goes, do you know what it feels like to have a boat? And I go, no, but it's got to be awesome. He goes, what I want you to do is go to the bank, take out $20,000 to $30,000 in $100 bills. Then I want you to go get a chair, because I want you to be comfortable, and put it inside your shower, right outside your shower. Run the water a little bit, and then light them on fire. He said, just go ahead and do that. He goes, do that, or just go ahead and hang out with me once or twice a year and buy all the food and all the booze, and we're good. Because unless you're passionate, but for those who are passionate about it, that's great. But go ahead. We digress.
We digress.
Okay.
So we had 10% on the inquiries, 10% on the types of credit, revolving versus installment, and then variety of installment. And then the remaining 15% that we haven't talked about is the age of your accounts. So how old is your oldest account? And then what is the average age of all your accounts?
Yep.
And so you may have heard that you don't want to close out an account just because you're not using it anymore, especially if it's a very old account. And the reason is because it's going to impact not only the oldest account on record potentially, but definitely the average age of all your accounts.
Yeah.
And so if you're just starting out, right, you don't have a lot of longevity there. So any account that you have, you're going to want to keep open. Doesn't mean you need to use it, but you need to keep it open.
That's right.
All right. So those are the 5 elements.
Good. All right. So we're done talking about kind of the 5 elements of a credit score, and then let's talk about what's the number one. There's one out there that's kind of owned the market, but other people are nipping at its heels.
Oh, the score?
Yeah, the score, and the rating agents, all that stuff.
Yeah, so the Fico Score.
Fair Isaacs.
Yeah. 1989 is when it came into existence.
Good year.
And essentially it's that range, that score from 300 to 850 that a lender is going to use to determine how big a risk are you, or what is the likelihood that you're going to pay them back if they loan you the money. 850 meaning highly likely. 300 pretty much impossible that you'll pay them back.
All right, quiz time. State with the highest average credit score.
Ooh, that is a good question.
Think Midwest.
I'm going to have to go with Minnesota.
Yeah, Minnesota. Yeah, real good now. Yeah. So Minnesota. There you go. So Minnesota, and the worst?
Going to have to go with Mississippi.
Mississippi.
Yep.
Yep. So there you go. All right. So let's go ahead and talk about the other, because Fair Isaac, really, the FICO score, that's what they're going to look at. Mm-hmm. But now some of the rating agencies some of Fannie and Freddie and some of the mortgage agencies are now saying, we're going to let you look at another one. They're starting to do that, and that is the
Vantage score. So that came about in 2006. So maybe we should take a step back. So this FICO score is calculated off of each of your credit reports from the three major credit bureaus. Actually, they can be calculated from any credit reporting agency, but fundamentally in the United States, there's three big ones.
TransUnion?
That's one.
Equifax?
That's second.
Experian?
And that's the third.
Rob Kron?
No, that Soon. Might be a place that we should look. So keep your eyes peeled for an old guys in t-shirts on how to open your own credit reporting agency.
Done. Go ahead.
But not now. It's just TransUnion, Experian, and Equifax. So those are the big three. And so each of those produce a credit report. And then each of those credit reports drives a FICO score. And so you'll have three different FICO scores, one for each credit reporting agency. And in 2006, those three agencies got together and said, these Fair Isaac people, they've kind of cornered the market on this, and we're the ones with all the data and the reports. Why don't we put together our own score? So they did. 2006, they came out with the Vantage score. Didn't really gain a whole lot of traction. They've revised their methodology. I think 2013 or 2014 was the last time they revised it again. So I think they're on Vantage 3.0 right now. Okay. But as Brett mentioned, it is starting to pick up traction with different lenders looking towards that score. The point is, it's still looking at essentially the same stuff. They might just be applying the ratios a little bit differently.
But it's still those five things.
It's still those five things, maybe in different ratios. But I did want to mention that for younger borrowers, there's a new score that's being tried out with by Experian in partnership with the FICO people called Ultra FICO. Right? Like they clearly spent a lot of time with the branding people to come up with a good name.
No, it should have been like Titanium Vantage or Titanium FICO or
maybe it was, and that failed miserably.
So
they decided to go with Ultra FICO. So essentially what this is, they're in the process of rolling this out. But if you go apply for credit and get denied because your credit score is too low, you may find that the person at the other side of the table asks, well, would you like to try qualifying using Ultra FICO? And translation, what they're saying is, would you like us to look at your deposit accounts, so savings accounts, checking accounts, any other account with on-demand deposits, money market accounts. Yeah, that was the word I was looking for. So if you allow them through, there's different apps and technologies now that allow you to provide the information necessary so they can essentially make inquiries for that information. What they'll do is they'll look at how long you've had those accounts, what your average balances have been, have you had any overdrafts? Essentially, have you been a good user of those accounts? And if so, that'll actually provide a higher Ultra FICO score than your regular FICO score and may actually allow you to qualify for that car loan or that mortgage that you were looking to take out.
Because again, the credit score is looking at those five aspects, and they haven't in the past looked at your cash flow, etc. And this is a way of saying, well, wait a minute, now we can actually bring that in.
Right.
I think it's a good idea. Because this is not a one-size-fits-all, and some people get penalized for different things that occur to them, and the way their cash flows are earned, and the way their credit, how credit utilization is done through their business or through their home life. So,
yeah, it's a common misconception that people think, oh, well, the FICO score is everything, right? So I just need to make sure I have a good FICO score, and then I'm going to get whatever loan I want. And the answer to that is no, not necessarily. While your FICO score doesn't include your income and how much money's in your bank account and whether you have a job or all that kind of stuff, the person loaning you the money
is going to want to know that.
Yeah, is probably going to ask those things. And so it's the combination of that FICO score and whatever other elements they feel are important in deciding to loan you money. But probably the biggest determinant in what rate you're going to get is your FICO score.
Yep.
Right?
So we talk about this FICO score or a Vantage score. So how long does something stay on a report? Because I always get that from clients. So if I don't pay my electric bill, or I have a medical bill that gets sent to a collection agency, or I declare bankruptcy. So how long does that? And I know it varies.
Yeah, it all varies. So why don't we look at each of those individually? So let's start with the easiest and the ones that come off the quickest, which are the inquiries, the hard inquiries. So you went out and you decided you needed a new credit card, or you wanted to go buy a car, so you took out an auto loan. Those inquiries really only factor into your score for about 12 months, and they only show up on your credit report for about 24. So after 24 months, any of those inquiries are going to disappear and won't be visible on your report anymore. Probably, though, the most important, the ones people are most worried about is, so I missed a payment,
Yep.
and I ended up being late on paying that. How long is that going to hurt me? And there's two answers to that question. The first is, it might not hurt you at all if your lender didn't report it as being late.
Yep.
So oftentimes, a credit card company, if you missed one payment, isn't going to report that as late. Now they might, right? So you
I guess they're waiting 60 days. Then
you need to see, but the most important factor is, did it get reported? And you'll find that maybe it got reported to one of the three agencies or two of the three agencies. So that's the first thing to look at, is, did it get reported or not? So is it on your report? But then if it made it onto your report, so for anything that was reported as a late payment or an account overdue, those will be on there anywhere from 3 to 7 years, and that's probably the most damaging element to any credit report, is when you're late or you've missed payments. So those are the ones you really want to pay attention to and know that they're going to stay on there a lot longer than those inquiries.
Yeah, I went and I was getting a mortgage for my house a couple years ago, and they came back to me and they said, well, you have this issue on your credit report. And I said, well, what is that? And they said, well, you missed a payment for a student loan of $89. Now, this was a student loan that we had co-signed for one of our relatives. I guess I did or Dawn did. I don't know how it worked out. Dawn's my wife. And so it was $89. And you would have thought it was the biggest deal in the history of the world. Now, what had occurred, it was 60 days, and then they reported it.
Yep.
And it was all because he moved, so he didn't even, nothing had caught up to him. So everything was fine. There was never another issue, but it had happened 4 or 5 years before. And I actually had to write a letter saying what happened. And of course, the letter I wanted to write was, it's the only thing that's on there, and it's $89. And I'm borrowing hundreds of thousands of dollars. So it was one of those things, and I know it was a check the box thing on the mortgage, but I was shocked that was on there. And so then one of the things I did was I said, anytime, because I've co-signed different loans with different relatives, whatever you do, make sure that it doesn't go past 60 days. If it's going to be past 60, let me know, because it can affect me.
Yeah.
But I called up and I said, hey, it's what was the deal here? And they said, over 60 days, that's when the student loan, at least for this company, that's when they report it. Not 30, but 60 days.
Yeah, and so what's fascinating about that is, first, it really isn't the amount. I guess that's part of it, but the fact that you just have a missed payment in there is what's going to hurt you. And I think we're a little negligent in not talking about, so this credit report, right? Is it some just big mysterious thing out there that you have no access to? or is it a document you can get your hands on and review proactively to make sure that you don't get surprised by, hey, you have this, bad mark on your score from 4 years ago. Reviewing your credit report, it's kind of important. We haven't talked about that yet, so let's spend a little time on that.
Okay.
Everyone should be reviewing their credit report on a regular basis. That way you're not surprised by something that shows up that shouldn't be there, or you're at least aware of something that, it shouldn't be there, but it is because you did something you shouldn't have. And so the government has made it a requirement that each of those 3 credit reporting bureaus make available to you your credit report once a year. And the place you go to get it?
Annualcreditreport.com.
That was a compelling commercial for that website.
But be careful, though, because you can go onto it and they send you through different searches or whatever, and then they say, oh, no, now you have to pay for it.
Well,
but
so
you don't.
So here's what's interesting, right?
You don't.
They'll give you your credit report for free, but then every single agency, and so again, the way the process works is you go to the website, you sign up, and then you go to each of the bureaus to request your credit report. And getting the report's pretty straightforward, but after you get that report, at each 3, they do it a little bit differently, but all of them will try to sell you your credit score, right? And they'll probably try to sign you up for some level of service, and they might even try and get you to subscribe to some additional security measures. So you don't need to do any of that, right? You can get your report. And you can only get it once a year, so once you've requested, you got to wait a whole nother 365 days to look at it again. But everybody should do that.
I'm just gonna add something
As you should.
As you should, whatever it is. About 17, 18 years ago, I went ahead and got our credit reports, and I'm not throwing my wife under the bus here.
He's going to throw under the bus. Here comes.
We had 32 credit cards, or she had. And they all were, the Gap or this or that, because what you do is when you sign up, they give you 10% off your first purchase. So she had all these credit cards. And, $500, $1,000, $2,000, whatever they were. It wasn't huge amounts, but it was like, holy heck. And she said, I went home and I was like, look at all these. And she said, no, I've gone ahead and cut them all up. And no, because she wasn't using them.
Yeah.
But the point is, and I didn't even know she had them. The point is, though, that it was still in the system. So if somebody would have stolen her identity or whatever, conceivably they could have gone after that. So one of the things I did was we had already bought our house. We weren't going to be buying a car anytime soon, etc. I just said, you know what? Let's just cancel all of these because some of them have been open for a long time. So that can actually harm you a little bit. But if you wait a couple years, then it becomes less and less important. So that's why if we were going for a mortgage or we were going to try and buy a car, and borrow money to buy the car, I probably wouldn't have done that. But I said, all right, we're not doing anything for a couple years, so let's go ahead and cancel those cars, which is what we did.
Right. And so, again, that's an important reason to look at your credit report is to make sure that everything on there is accurate. And that can fall into a couple of different buckets, right? It can be making sure that they've got your name right. They'll also show up other aliases. And so if there's some alias on there that you've never used or seen, like you got to look into that and get that fixed. There could be accounts on there that you don't even recognize, right? So you're like, I see something for the Gap and you've never shopped at the Gap before. That could be a fraudulent use. That could be somebody who's opened an account on your behalf. So you're looking for errors, but you're also looking for fraudulent activity. And you can dispute anything that's on that credit report. So
even if it's a late credit, even if it's a late, you made a late payment on your credit report, it shows up, you can actually dispute that.
So I had actually an issue with that where they said I was late on something, but I wasn't. And, it was a back and forth and it can take a long time to resolve. But it's worth it to make sure that it's accurate, because that will impact your score and will also make it harder for someone to take credit out in your name when they're not when it's not you. So you need to make sure that you review it for those two things. Go through the dispute process, which is listed somewhere on that form of how you go back and dispute it. And if you ever have an issue with that process, right, you can reach out to the Consumer Financial Protection Bureau and file a complaint with them, and they will work to resolve it. So again, important to request a credit report, review it for accuracy, both information that's not correct as well as information that's not even you, right, fraudulent stuff, to make sure that, again, you are having the best credit score you possibly can.
And I don't want to scare you, but I've done a fair amount of work with abused women shelters as a volunteer, and also just being in the business for a long time. But I am shocked at the things that I see where ex-spouses will go ahead and take cards out in the other spouse's social security number, send them to a P.O. box, and then after they use the card, the other spouse has no idea. They use the card, and then after a year or two, they request an increase in credit. Now, they've been using it and paying it off, so the credit card company says, oh, you were at $2,000, we'll let you go to $5,000. And they get somebody else to pose, their girlfriend or whatever, to pose as their ex-spouse or their current wife that they're estranged from. And then they jack it up to $5,000 or $10,000, and then they take it all, use it all, and then never make another payment. Kids have done this. I've seen this with children. They get mom or dad's social security number, and they go ahead and open accounts. And they send them to P.O. boxes, and they do similar things. I think it's important to see what the heck is on your credit, because you're responsible. Your credit report, you're responsible for it. It's really important. So I don't mean to scare you. I'm sure you're in good shape. But a lot of people don't know this. I opened up an account on Rob's social security number. And you know what? I'm glad I did it. I'm telling him now, I'm coming clean.
Thank you. Yes.
Okay,
well, I appreciate
so you
that.
want to look at that.
I will clearly be using this
paying.
video
I'm not
when I sue you for taking advantage.
No, this isn't a video. This is
no.
Just kidding. We're all kidding.
Just kidding. Brett, you had mentioned that when you go to annualcreditreport.com, understand that the credit report is free, and they're going to try and upsell you to get your credit score and monitoring services and other stuff, which you don't have to do. You can actually get your credit score for free as well. There are other sites that will do that. One of the ones that I've used is creditkarma.com, which is a completely free source for not only your credit reports, but your credit score at each of, actually it's not at each of the agencies. I think they only have arrangements with 2 of them. I don't think the third is playing ball with them right now. But the point is, you can get your score for free. But what's the catch?
What is the catch?
Because there's always a catch. So the catch is they are going to email you on a fairly regular basis with offers that they think are appropriate for you, given the fact they know what your credit score is. So you're going to find, once a week, they're sending you a suggestion of credit cards you should be applying for based upon your credit score. But they also send some other interesting articles about managing your credit and other things to think about and be financially savvy. So it's not horrific spam mail, but you just need to be aware of the fact that they clearly need to make some money somehow, and the way they're doing it is by making offers for different credit products that are aligned to your credit score. And again, I guess enough people are taking advantage of those offers that they're able to keep the lights on. But something I would suggest you take advantage of.
I've had clients use it, and they've been very happy with it. Rob actually, I'm just gonna say it. Rob got a loan on his Ferrari, actually through Credit Karma, because they were like, if you're a playa like he is, then you should have a red Ferrari. So he was like, but I don't really have the money for it. So they said, no, take out a loan.
Yeah,
so Credit Karma, I'm just saying. So that's positive.
I really need to stop opening up to you, because you clearly don't know where that line is between you and I and everyone.
It's just us, Rob. All right, so seriously, okay, let's what we want to just talk about one thing that deals with different generational issues here. So believe it or not, you would think, okay, older folks, they got great credit.
They do.
But you would think it was even better. It's actually, they're taking out more loans. They're getting into more debt. Their credit scores are actually coming down. Now, they're not as low as people who are under 30, young adults, as well as then the people between 30 and 60 that are dealing with kids and all that stuff. But it just shows you that every generation now has become a generation of debt.
Well, it's fascinating. So while people over the age of 72, I think it is, 71, 72 is the way they cut the data, still have the highest credit scores on average, they're actually the only age group that since 2008 have had their credit scores go down. All the other age cohorts have had their credit scores kind of slowly trend up after the Great Recession. But interestingly enough,
because we've been in a recovery, and I think they haven't seen as much of that, especially as they've been in retirement.
And been on fixed incomes, right?
Yeah.
And
so they haven't seen that.
So we've seen their mortgage debt go up, their revolving credit go up, and as a result of all that, their credit scores have gone down 40 or 50 points. I think on average they were in the high 700s, and now they're in the low 700s, which again is the highest of all the age cohorts. But it's surprising to me that they've taken that much of a hit.
All right, we would be remiss if we didn't use the B word. We're going to talk about the B word.
We are. I thought
bankruptcy. Bankruptcy. So we're going to talk about bankruptcy. So people say, well, I'm never going to declare bankruptcy. Well, that should be a goal. You do not want to declare bankruptcy.
No.
However, there are times when it's going to happen. Remember, bankruptcy will really be dealing with your, it deals with all of your debt, but it especially affects your unsecured debt. So you look at it and you say, now wait a minute here, I declare bankruptcy, all my debts are wiped away, credit card debts. And the answer is not exactly.
Not exactly.
So if it gets complicated, but roughly think $60,000 a year. If you're making over we'll say under $60,000 a year on average for the last 5 years. So on average, you can declare, it's called Chapter 7. I call it lucky bankruptcy because everything gets wiped away. Okay, so that's that. If you're over $120,000 on average a year, it's $10,000 a month for 60 months. So you're making over $120,000 a year on average. Then you have to do something called a Chapter 13, which means you just are going to have to pay some of that debt back. In fact, you're going to pay a bunch. So 13 is a little unlucky. And then if you're in between there, it's just a different thing that you have to deal with. And you have to go through credit counseling, and you have to do a whole bunch of other things. But the big question is should I declare bankruptcy? And one of the things in different aspects of financial planning that I've dealt with over the years is people have come to me and they make $50,000 a year, and they're $50,000 in credit card debt.
That math doesn't work, Brett.
Yeah, I'll say to them, you're never going to get out of debt. And they say, oh, well, I'll get rid of all these student loans if I declare bankruptcy. No, you're not going to get rid of those student loans. So one of the things is I say to them, look, at least for that part of it, you should go ahead and declare bankruptcy. Then I have other folks who just went through a difficult time. So it was one of their spouses lost their job. They had huge medical payments. They had parents had issues, or their children they helped out, or adult children they helped out. So they basically went through a one-off type experience where they have all kinds of credit card debt, etc. And then I say, look, they'll say, should I declare bankruptcy? I'm like, well, you're making $200,000 a year, or $150,000 a year. You know what? I think you can get out of this. The key is then not going back into, it's a lifestyle thing, making sure that it was just a one-off,
right,
and it wasn't going to be worse. So one of the things we talk about with bankruptcy, how long is this going to stay on my credit report?
So it's a big, fat, juicy depends, right? So if it was unlucky or Chapter 13 bankruptcy, that's going to be there for 7 years. If it was Chapter 7, or lucky bankruptcy, that's going to be 10 years.
So it's going to stay on there for a while.
A long time. So you really need to be thoughtful about whether or not you're going to do this, right? It is not a cure-all panacea, because you're going to find for 7 to 10 years, nobody's going to want to loan you money, right? Because you've got bankruptcy on your credit report. And so, the only money you're going to qualify are at just astronomical rates and requiring probably some level of collateral before you'd be able to borrow it.
Now, remember, I've always been surprised with folks I've worked with after 2 or 3 years, they start getting things from credit card companies, but they're really not the credit card companies you want. I mean, literally, it's whatever the highest interest rate it can be, and this and that. So people will say, Mary, well, this was a one-time thing. How do I get out of this? Or how do I deal with it? There are some things. I'm not a huge fan of taking loans out on a 401k, but to pay off credit card debt that's at 20%, I got to tell you, I think that can make sense as long as you don't run up those credit cards again. If your lifestyle and your expenses are just going to run it up again, then that's not going to help you. Taking a loan out for cash value or cashing in if you don't need it, life insurance. So that is one thing. Another thing that I've actually worked with a number of folks about is that they're going to get some sort of inheritance from their parents, and their parents are older. And I said, look, you've got 3 siblings. Just say, look, I'm going to take out 50 grand, and I'm going to get my part of my inheritance early. Now, if your parents or grandparents don't have any money, that ain't going to help you. But I'm saying these are ways that you can go and say, look, this is fair. I'm taking money out. If you even want to say, because I got it 10 years early or something, I'll make it even a higher amount that I won't get paid out. I'll charge interest on it, however you want to do it. That's fine, but it won't go into effect until the person actually passes away. So those are different things. You can go begging on the street. You could do that. I am thinking about, like, if I needed it, I would wear a sandwich board. I could make a lot of money. Or those dudes, you ever see they do the flippers? Boy, I tried that once. I almost hurt myself.
That requires skill.
It does.
Which you don't have.
I don't. As everyone knows, I peaked as an athlete when I was 11. I was good. No, seriously, like at 11, with Little League and stuff. And then after that, it's kind of been downhill. Yeah. So anyway, so that's what we're talking about with bankruptcy. So what about life after bankruptcy? So just know that it is going to affect things. I think it's important to talk to your children about that, about, hey, this isn't something that, it's easy, that you can just, you can get out of child support. You can't. Not with bank. You can't. So if you go ahead and you say, well, wait a minute here, I don't want to pay alimony, child support, I don't want to pay student loans. Sorry, those are things you're going to get. Taxes. I don't want to have to pay my taxes. Guess what? That doesn't get forgiven by bankruptcy. So I think, it's not something that you want to have happen, but it is part of life. And so those are things just to talk to your client about, and then have your client or your friend or whoever, relative, actually go then and talk to a bankruptcy lawyer in that state, because the individual states have different rules as to what they count as equity in your home, equity in a motor vehicle, etc., etc. So
the other element of that is, again, any bankruptcy requires that you go through credit counseling, debt counseling. That counseling is really important as well, because as Brett was talking about earlier, understanding how you don't end up here again is really important, and also understanding that, is this the right choice? Right? If you have a path out where you don't need to declare bankruptcy, right, you probably want to take that so that you don't have that 7 to 10 years of just real struggle as it relates to things that you may take for granted right now, like being able to get a credit card, buy a car, rent an apartment.
And it's not even just those things. If you go for your homeowner's insurance, your auto insurance, life insurance, all of those things, they are going to look at your credit history. They're going to get your credit score. And why does that matter? Because people have less accidents. People have longer life expectancies. People actually are a better risk if they have a higher credit score and a credit rating. So it doesn't mean that that's absolute. You can have some people who have high credit scores and they're an absolute disaster. But for the most part, that's the way the numbers work. So
let me ask you a question, Brett. So if I did declare bankruptcy,
Yeah.
and I'm young, and I now need to rent an apartment, and I've got bankruptcy on my record, like, what do I do?
Tell him or her, whoever you're filling out the application, be upfront about it. I've had, it's interesting you asked that, because I've had a number of folks, and they've gone ahead, and I always say to them, the person's going to find out anyway. So just go ahead and tell them it's an issue, and then explain to them why it happened, and then explain to them why it's not going to happen if you go in. And these are all for renting an apartment.
Mm-hmm.
All right, so that's something that's going to be really important. And it happened, I probably dealt with this 5-6 times throughout my career, and only one time did the person not get the apartment. All the other times, the person said, I would have just, said, that's it, but I liked you, and more importantly, you were upfront about it. You actually were saying, hey, I got this issue, here's why it happened, here's why it's not going to happen again. And I was like, you know what, I appreciate when somebody does that, and that made it easier for me to rent the apartment to you. And
Yeah.
so I think that's important.
I think that is an important lesson with everything we've talked about here, is that your FICO score and your credit report, those are things that lenders look at to make a decision. And while that score is, again, calculating the likelihood that you're going to pay it back, the lender ultimately is making the decision whether they're going to loan you the money, whether they're going to rent you the apartment, whether they're going to issue the credit card, whatever it is. And so there's a number of other things they may evaluate. And for a landlord, right, there is the opportunity to have a personal relationship there, build a bond by just being honest about your situation, and you may find that it actually, helps you.
Absolutely. So, what did we learn today? Well, we learned many things. I mean, it was unbelievable.
But what of value did we learn today?
All right, we actually do have fun. Anyway, so here you go. So, what goes into your FICO? Why credit's important? What goes into your FICO score? What else did we learn?
Well, so if we were to try to be organized about it, and maybe put even a graphic up that summarized those things that we went through, I think that we might say that, yes, we started with understanding what is credit and why is it important. We talked about a credit report, what it is, how it functions, the importance of reviewing it and making sure it's accurate. Then we talked about how that credit report generates a credit score. And we talked about the 5 different elements that drive that score. So it's your history. So did you pay on time? It's your utilization. So how much credit are you using relative to your limit? We talked about the age of the accounts that you have. We talked about the different types of credit that you've consumed. So installment versus revolving. And then we talked about inquiries, those hard inquiries of exploring taking on additional credit. So those were the 5 things we talked about. And then we covered a number of other issues then related to the use of credit.
Yep. As well as finishing up with bankruptcy.
Right.
And that's all I have to say about that. What about you?
That is all I have to say about this particular topic.
We'll go team fight win.
Yes.
Bye-bye, everybody.
All right. Thanks for watching.
Be the ball. Nothing but net.